Welcome back to Finance Depth. In today's video, we are going to see mutual funds in depth. So this is the third video in the stock market series. If you haven't watched the previous two videos, go ahead and watch them. I'll give a link to the playlist in the description below. So if you have liked the series until now, don't forget to subscribe to the channel. And without wasting much time, let's get started with the video. So first let's understand what is a mutual fund. Mutual fund by definition is a pool of fund that is collected from different people like you and me and invested in assets like stock market or bond or even commodities like gold and silver. And this mutual fund will be managed by something called AMC or asset management company. Of course, company is not just a building, right? There will be people in the company. So the main folks in the company who run the AMC or who run a fund are called fund managers. Of course, it is not just the fund managers. There will be research people as well who will be researching the stocks or the assets. Then there are investors like you and me who will give the money to the AMC, and with the collected money, right, these fund managers will invest in the assets like stocks, bond or commodity. Commodity is nothing but things like gold and silver. So this fund, which is mutually collected from different investors, is called as mutual fund. Now let us understand why mutual fund exists. I can directly invest in stocks, right? Why do I need mutual fund? So the first thing is professional management. You don't have to do any research about the stocks. These professionals will spend their time. It's a full-time job for them. They will do all the management like researching the stock, which stock to buy, which stock to sell. All these decisions will be taken by the fund managers for you. So you will get an expert guidance with very minimal cost. We will come to the cost of mutual fund later in the video. And now the next benefit of mutual fund is diversification. Let us say you have 500 rupees to invest, right? You won't be even able to buy one stock of, let's say, Reliance or HDFC Bank. It costs more than 500 rupees, right? So with mutual funds, right, you can start as small as 500 rupees. Usually these mutual funds invest in a basket of stocks, not just one stock. If you have watched my previous videos in this series, you would already know that by now. So next is low entry barrier. We have already covered that in the previous point. That is, you can start with as low as 500 rupees. Then is liquidity. This is one of the most important benefit of mutual funds. Unlike instruments like real estate where you invest, right, you won't get liquidity. Let us say I want to sell tomorrow, right? You'll have to find a buyer at the price you want, then only you'll be able to sell. And it has a lot of process, right? With mutual funds, right, you can sell whenever you want, and in 2 to 3 working days or 2 to 3 market days, you'll get your money in your bank account. The last point is long-term wealth creation. Let us say you invest in equity mutual funds, right? Basically, equity mutual fund is a mutual fund which invests in stocks. Next, let's see what are the types of mutual funds. As per SEBI, who is the regulator for controlling all this mutual fund and stock market, there are 36 different categories of mutual funds. You don't have to know all these categories, and as a beginner, right, most of the categories can be avoided. So we will go in detail and find which are all the funds you can avoid and which you can invest. And at the top level, we have got 5 categories. The first one is equity funds. As I have already explained, equity funds invest in stock market or buy and sell shares of stocks or company. Next is debt funds. So debt funds will invest in instruments like debentures or bonds. So what are debentures and bonds? I'll just explain in one line. So debentures or bonds are the loans you will give to the companies. Let us say Reliance wants to borrow money from the market. What it can do is it can issue debentures. That is nothing but taking loan from the market. So to take loan or debt from the market, it will issue debentures, and these fund managers or AMCs will buy these debentures. When you invest in debt mutual funds, right, your money will go to AMCs and AMCs will buy these debentures from company like Reliance. Now what is bonds, right? Bond is same debt that is given to the government. So generally debentures are issued by private companies and bonds are issued by government. So of course bonds are more safer than debentures because bonds have sovereign guarantee in them. And debt mutual fund is a very broad topic. I'll do a separate video on that, how to invest in debt mutual funds and what are all the different categories and what is the risk and what is the return you can expect. Next is hybrid funds. Hybrid funds is the combination of equity and debt mutual funds. They invest in both equity and debt. And next to are solution oriented funds and other mutual funds. We will see the definition of this when we come back to them. First, let us see what are all the different categories in equity mutual funds. First is large cap fund. Again, if you have watched watched the previous video, you will know what is large cap, what is mid cap, and what is small cap. To recap, I'll just say large cap invest in top 100 companies, mid cap in the next 150, and small cap in the remaining companies. This is by market cap. Again, I have explained in detail in the previous video what is market cap. Go ahead and watch that. So we have covered large, mid, and small. Then there is large and mid cap fund, which is a combination of course, large and mid cap. Then we have multi cap. Multi cap funds invest minimum 25% in each large, mid, and small cap. That is 75% done there. Remaining 25, it is the fund manager's choice. They can invest wherever they want. And the next is flexi-cap. Flexi-cap is very similar to multi-cap, but the thing is, here there is no limit. It is up to the fund manager to choose which cap to allocate. There is no regulation that you have to invest minimum this much or maximum this much. Then is focused fund. In focused fund, fund managers will invest in stocks up to 30. That is, they can hold a maximum of 30 stocks in their mutual fund. Next is dividend yield funds. Dividend yield funds will invest in stocks which pay dividends. Most of the public sector companies like Coal India, NTPC, and all those companies, right? They will give high dividends. If you're a beginner, you can avoid this focused fund and dividend yield fund. Next category is value fund. What value fund managers will do, right? They will find stocks which has low valuation or low P. We will see what is P and PB, price to book ratio, in the fundamental analysis video, which I'll be doing later. Just understand that these are good companies, but they are undervalued, or they are priced less than what they actually should be. Let us say company's fair price or fair value is 100 rupees, but now it is trading at a discount of 90 rupees. They will identify stocks like that and invest in them. Next is contra fund. It can be easily confused with value fund. Contra funds will invest in sectors which are ignored or which has been beaten up a lot. Let us say today IT sector is beaten up a lot, right? You'll see contra fund managers picking IT stocks. Next is ELSS. ELSS stands for Equity Linked Savings Scheme. If you know income tax, right, there are two regimes, old regime and new regime. When you opt for old regime and you want to invest in equity scheme or equity mutual funds, right, ELSS can be preferred. It has a lock-in of 3 years and it gets the ATC benefits, that is up to 1.5 lakhs. I firmly believe there should not be any lock-in for equity mutual funds, so ELSS can be completely avoided along with the contra and value fund, unless you have some experience in the mutual fund or you understand the market cycles. You can completely avoid value and contra funds. These value and contra funds will give you real pain in the bull market. So when you see your friend's portfolio or other funds doing really well and you have value and contra fund in your portfolio, right, you'll feel the pain. So as a beginner, you can totally avoid them. Next is sectoral funds. Sectoral funds invest in particular sector like IT, pharma, and so on. Let us say you believe certain sector is going to do well, then you can invest in sectoral funds. Again, not recommended for beginners. Similarly, thematic fund, let us say you'll hear EV will do well in the future, then you can consider investing in EV focused funds. Again, beginners can completely avoid this. Next is debt fund categories. I'm not going to go in detail about this. I'll do a separate video for that. And these are few categories. I have more in the upcoming slide. If you already have debt allocation in your portfolio, like let us say FD, PPF, or any other investments, then you can completely avoid this. If you want to park some money for a short duration, let us say you are awaiting a crash in the next 6 months or 1 year, then you can keep the money in liquid fund and you can do an STP, that is systematic transfer plan, from this liquid fund to an equity mutual fund in a systematic fashion, or you can just withdraw it and do a lump sum investment as well. So when you give loan, right, there will be duration. You can give loan for 1 day, 1 month, 1 year, 10 year, and so on, right? And the funds at the top have less duration, and as we go below, right, the duration increases. And a very important point to note with debt mutual funds is that as the duration increases, they are more susceptible to interest rate cycles. That is, the longer the duration, more it will fall during interest rate cycles. To simplify, when the interest rates have bottomed up and about to go up, these debt mutual funds will give you low or negative returns. And when the interest rate has stopped and about to fall, right, these debt mutual funds will give you good returns. So only if you understand this interest rate cycles, right, then only you should consider investing in long duration debt funds. And here are more debt funds. All these can be avoided as a beginner, and again I'll do a detailed video on these funds. Next is hybrid fund categories. This is an interesting category. So first let's cover these three: conservative hybrid, balanced hybrid, and aggressive hybrid. So based on the percentage percentage of money that is invested between equity and debt, right? They are classified like this. So in conservative, 75% to 90% of the money goes to debt and the remaining goes to equity. And in balanced hybrid funds, you have to invest minimum 40% in equity and you can invest up to 60% in equity. So similarly, in debt, you have to invest minimum 40% and maximum 60%. So that's why it is balanced. Always the fund will allocate somewhere between 40 to 60% in both debt and equity. Next is aggressive hybrid. Here, minimum 65% you'll have to invest in equity and maximum is 80%. Next, we have dynamic asset allocation or balanced advantage fund. Here, there is no limit. You can go up to 100% in equity or up to 100% in debt. But for the tax benefit, right, we will see what are all the tax implications in the upcoming slides. But for this particular point, right, so for the tax purpose, right, usually they will keep minimum 65% in equity. That is gross. We will see what is gross equity and net equity in a while. Then we have multi-asset allocation. Multi-asset or multi-asset allocation is nothing but they will invest in multiple assets like equity, gold, real estate, and debt. Let us say you don't understand asset cycle or you want to invest in all the assets, then you can go for multi-asset. Next, we have got arbitrage fund. So what is arbitrage fund, right? So I'll just give you a simple example of what is arbitrage. You know there are two major exchanges in India, right? One is NSE and BSE. And a lot of stocks are traded in both NSE and BSE. If you observe closely, right, usually you will find price difference between the stock traded in NSE and BSE. So let's say one stock is trading at 100 rupees in NSE and it is trading at 101 rupee at BSE. Then what you can do, right? You can buy in NSE and sell in BSE. Of course, the price difference won't be that much. It will be in 5 paisa or 10 paisa. That price difference is called arbitrage. Of course, in real life, fund managers won't buy in BSE and sell in NSE or do vice versa. That is not practically possible or it is not economically viable because there is spread cost, there is transaction cost. All this will negate your difference. So what actually happens in arbitrage funds, right? I don't know if you have heard about future and options or derivative segment or not. So there is something called futures and there is something called options. Of course, we'll be covering F&O in one of the upcoming videos. So to understand this, just understand there is something called derivative. They will trade in derivative segment as well as cash segment. Buying stock is called as investing in cash segment. So they will do a combination of cash segment and futures. Let us say in futures, the stock is trading somewhat premium, let's say 7 rupees premium. And the cash segment, it is trading at discount, right? Then you can buy the stock in cash segment and sell it in the future. And you can pocket that difference. That is actually what fund managers will do. They will enter this trade only if there is an opportunity. So when it comes to taxation, right, they are treated as equity, but they give you stable returns like debt. Next is equity savings fund. This is very similar to balanced advantage fund, but they invest very less allocation like 10 to 20% in equity and remaining in debt. This is mostly recommended for retired people and beginners can totally avoid this. Next is solution oriented fund. Totally can be avoided by beginners. They are mainly for the marketing purpose. Let us say retirement fund and children's fund. These funds follow very similar fashion of either balanced advantage fund or flexi cap fund. So you can totally avoid them. Then there are other fund categories. The first is index fund. So as I have explained in the previous videos, right? Index funds track the index and they invest in index like Nifty, Sensex, Bank Nifty and so on. There are a wide variety of index funds based on market cap, based on the sector, based on the strategy. Again, I'll do a separate video on index funds. Then there is something called exchange traded funds, ETFs. Again, we covered in the previous video. To summarize, ETFs are nothing but the same index funds which are traded in the exchange, or you can buy ETFs directly from your broker. You don't have to go to the AMC or anything to buy these ETFs. Of course, you have to have a demat account to buy this exchange traded funds. Then we have got fund of funds. So fund of funds, what they do, right? They will go and buy basket of mutual funds. So mutual fund itself is a basket of different stocks. So fund of fund is a basket of different funds. These fund of funds are mainly used for investing in foreign equities or for investing in gold or silver ETFs. So a gold mutual fund or a silver mutual fund will usually be a fund of fund. Fund of fund can be totally avoided because you will incur double cost. One is the cost of the underlying fund and then the cost of funds. So you can totally avoid this fund of funds. And next, let us see what is the cost of mutual fund, or what are all the charges you have to pay. So first is expense ratio. Expense ratio is the percentage of money that the AMC will deduct for its expense, like paying salaries or doing the research before investing your money in the stock market. So if you see the historical returns of mutual funds, right, that will already price in this expense ratio. So it is not something you pay at the end. Whenever you're investing, right, that time only they will deduct and then only they will invest. Let us say the expense ratio is 0.5%, right? Then if you are investing 1000 rupees, then 5 rupees, that is 0.5% of 1000 rupees, will be deducted, and only the remaining 995 rupees will be invested. This won't be shown in the investment that you have invested only 995 rupees. It will show as you have invested 1000 rupees, but the price of the mutual fund will reflect that expense ratio. Next is exit load. So mostly equity funds have like 1 year lock-in. Most of the equity mutual funds have something like this. If you withdraw more than 10% of the invested value within 1 year, right, they will charge you like 1% of your investment as exit load. If you're selling after 1 year, you don't have to pay this exit load, and this exit load varies from fund to fund. So you can go to websites like Value Research or the AMC's website to find out this expense ratio and exit load. So let us go ahead and check that. So let me search for HDFC Nifty 50 Index Fund. This is AMC's website. I'll open that. Then I can go to Value Research. I'll open that link as well. So if you see here, right, TER, that is total expense ratio, that is 0.2%. This is an index fund, so the expense ratio will be low because there is no research required to invest in an index fund. You just need to pay the fund manager's salary and the transaction cost. So that is the reason the TER, or total expense ratio, is low in index funds. And then here is the exit load. You can see what is the exit load. If you withdraw within 3 days, you have to pay 0.25% of the invested amount. If it is redeemed after 3 days, there is no exit load. Since this is an index fund, that is why we have 3 days of limit. If it's active funds, they usually have like 1 month or 1 year as the criteria for exit. Same thing, you can come to this Value Research website and you can search for the fund and can go to this other tab. You'll find the exit load here, that is 0.2%, which we have seen. You'll see the expense ratio here, which is 0.2%, as we have seen in the website, and the exit load is given here. So that is how you see expense ratio and exit load of a fund. And then there is internal transaction cost. You'll not be able to see that it will be internal to the fund or the AMC. That is whenever you buy or sell stock, right, you'll have to pay the brokerage and all those stuff. Next, we have a direct versus regular plan. You can invest in two different plans in a mutual fund. First is direct. So in direct plan, you buy directly from the fund house. In regular plan, you'll go through an intermediary or the mutual fund distributor. You'll pay commission to them. The commission will be paid by the AMC to the distributor. You will not be paying directly to them, but this commission will reflect in your NAV. So you'll get lesser returns compared to direct funds. So if you're researching on your own and if you are investing on your own, right, then definitely you should opt for direct fund. If you are going through a distributor or through via bank, right, they will of course will ask you to invest in regular plan so that they get their commission. So it's up to you to decide which route you want. You want the direct approach where you will do your own research and invest, or you'll take the help of distributor. Most of the time distributors will act as sales agent for the fund house, so they will give you whatever gives them the maximum benefit. So if you want to do financial planning, right, you can go for fee only financial planners who will take your fixed fee and they will not have any bias. So they will suggest which is best for you. Next is a growth and dividend option. So if you're trying to build wealth for the long term, right, you have to go for the growth option. And if you're looking for dividend like monthly or quarterly payouts, right, let's say you are retired, you want to go for monthly or quarterly payouts, then you can choose for dividend option. Of course, for beginners, dividend is not recommended. You have to go for growth option. Next, let's see what is net asset value. So net asset value is nothing but the price of the mutual fund. So usually when a fund is launched, right, that is called NFO or new fund offered, the price will be set to 10 rupees. Now as the underlying value, that is the stocks or the bonds or whatever the mutual fund invests, right? As the value of these assets grow, the price will also grow. So after market hours, right, usually around 11 or 11:30, all these funds will publish their NAVs. So you can go to AMFI's website, you can search for AMFI, that is Association of Mutual Funds in India. So I can search for AMFI NAV. I can click on this NAV download, right? I can click on this complete NAV report. So this is the text file for every fund out there, right? This will be published there. So if you see 13 March, today is 15th March, which is a Sunday. So the price of fund on Friday, that is 13th of March, is published here. So you'll see the price of all the funds published here. So that is nothing but the NAV of the fund. And one more thing to note here is, let us say a fund is having an NAV of 10 rupees and another fund is having a NAV of 50 rupees, right? That doesn't mean the fund which is priced at 10 rupees is cheaper. You won't get listing gains like IPO in NFO. So beginners should avoid investing in NFO. Next is SIP versus lump sum. We have covered this in detail in the previous video, so go ahead and watch that. To summarize, right, SIP is like investing in different intervals, like let's say monthly, quarterly, or yearly, or you can do even weekly or even daily. And lump sum is investing in one shot. So I have a request for beginners: never ever invest in lump sum. If you understand the market and you have been in the market and you have seen the market cycle, then only invest in lump sum. And always start with SIP. I have seen a lot of people in social media coming and complaining, I invested 10,000 rupees or 1 lakh 6 months back and my portfolio is down 20-30%. What should I do? My question to them is, why did you even invest in the first place? If you don't have investment horizon of at least 7 years, don't even invest in equity or equity focused mutual funds. Just stick to FD or whatever you understand. Don't come to stock market with an expectation that you will double your money in 2-3 years or so. Most likely it is not going to happen. So if you have long-term goals like buying a house, children's education, or retirement, which is coming after 10, 20, or 30 years, then only come and invest in equity mutual funds or buy stocks. Let us say you have marriage coming up in next 2 or 3 years, then don't take the money which is required for your marriage and come and invest in stock market, assuming that you will make a lot of money. You're most likely going to make losses. So I think enough of the rant and let's move on with the video. Next, let us see safety of mutual funds. You might have concerns, right? What will happen if the AMC goes bankrupt, or if you are investing through a broker, what happens if the broker goes bankrupt? Is my money safe? So to address that, right, this is regulated by SEBI. SEBI is nothing but Security and Exchange Bureau of India, who monitors that everyone is playing fair and there are no scams going on. Then whatever stocks or assets these mutual funds buy, right, they are held with the custodian like CDSL and NSDL. So mutual fund themselves won't have these stocks in their pocket or their account, and every month, right, mandatorily they will have to publish what are all the stocks they are holding and in what percentage, and all these are audited in regular basis, and there is no way they can do some gimmick and get away with your money. And let us say a fund gets bankrupt or facing huge losses, right? Then what happens is another AMC will come and acquire it. This has happened in the past. Let us say, for example, the Reliance Mutual Fund, right? That was previously owned by the Anil Ambani Group. That was sold to Nippon. That is a Japanese company. Now Reliance Mutual Fund is known as Nippon India Mutual Fund. This is just one example. There are other such instances as well. So your funds are safe even if the AMC gets sold or goes bankrupt. And the last thing is, as I have told, the returns are not guaranteed. If the market crashes or market does not do well, of course you are going to see losses. Next is taxation. Of course, any money or any profits you make, you have to give a cut to the government. So first let us see equity funds. A fund is considered as equity mutual fund if the portfolio has more than 65% of equity holdings. So STCG, the short term capital gains for equity, that is, if your holding period is less than 1 year, then you have to pay 20% flat tax on the profit. Holding period is nothing but the duration between the buy as well as sell. So let's say you buy today, March 15, 2026, then you sell within next March 15, 2027, then you'll have to pay 20% tax on the profit. And if you have made losses, right, then you can carry forward that losses. So for details, you can contact your CA. And next is LTCG, that is if you are holding for more than 1 year, right, that is called as long term. For taxation purpose, you'll be charged 12.5% tax on gains above 1.25 lakhs. That is, today you are sitting in a profit of 1 lakh in mutual fund. You decide to sell all of them, then you don't have to pay any tax. Only if your profit is above 1.25 lakhs, let us say your profit is 2 lakhs, then that difference, that is 75,000, right? From 1.25 lakhs to 2 lakhs, the difference is 75,000. On that 75,000, you will have to pay 12.5% tax. And of course, with this, right, there is one benefit, that is you can do long-term capital gains harvesting. Every year you can sell mutual funds with profits up to 1.25 lakhs and buy the same in another account or the next day, and you will get that tax benefit, and that 1 lakh will not be taxed in the future. And next, coming to debt funds, that is holding less than 35% of equity is called as debt funds. They will be taxed at tax slab. Earlier, before to 2024, there were different taxation, like there was indexation benefit and all those stuff. That is not relevant for this video because they have removed all those things. There is an article from Zerodha. You can go to that and read them. I'll give you the link in the description below. And next is hybrid and other funds. So hybrid funds are the funds which invest between 35% to 65% in equity, or the gold, silver, or international funds are also considered as hybrid funds. They have a short-term period of 2 years. That is, if you have sold within 2 years, you'll have to pay tax at tax slab for the profits. And if you're holding more than 2 years, similar 12.5% flat tax. Then dividend income, that is IDCW. If you have chosen dividend funds instead of growth funds, then it will be taxed at your tax slab, whatever income you get, and there's a TDS applicable. Of course, as a beginner, this shouldn't matter to you. These are the few important factors while selecting a fund. First is the fund category. We have already seen what category to choose and what categories to avoid. Next is expense ratio. Most of the influencers or market experts say that you have to choose a fund with less expense ratio, but I have a contrarian opinion. So if you're investing in an index fund, right, then definitely you have to go for a fund which has low expense ratio. But if you are investing in an actively managed fund, right, then I don't have a problem with the fund having higher expense ratio, because the expense ratio is already priced in the returns. Let us say fund A gave you 20% returns and the expense ratio was 1%. And fund B gave you 15% returns and expense ratio is 0.5%, then naturally you will choose the fund A, right? So I don't see a problem in paying extra premium for that extra returns. So that is coming purely from my experience and it's purely my opinion. You don't have to take it as an advice. Next is consistency of returns, right? You should always see the consistency of the returns. You shouldn't see just the last 6 months or 1 year return and invest. So to see the consistency of returns, right, again you can go to value research. Let us say I'll go for one of the famous funds, that is Parik FlexiCap fund. Of course, you have to see the past returns and the consistency of returns in actively mutual funds. In index funds, there is not much use of seeing consistency of returns because index funds are supposed to mock the index. We go and see the returns, right? I'll click on discrete returns, right? It will show past 10 years of returns. You can go ahead and see whether the fund has consistently outperformed the benchmark. This is the benchmark, that is BSE 500 TRI is the benchmark and the equity flexi-cap is the category. So you have to see whether the fund has consistently outperformed the benchmark or the category. So if you see if this fund, it hasn't in one, it has no, yes, no, yes. So what I do, right? If the fund has outperformed in say 60 to 70% of the times, right, then I consider that fund. This fund, you can clearly see it has outperformed in most of the times. So I'll be considering this fund. Of course, I won't directly go ahead and invest. I'll see other factors as well. Next is fund manager's experience. Again, you can click on this other tab and you will find the fund managers here. So you can see who is the fund manager here. This fund is being managed by Rajiv Thakkar from 2013. That is 13 years of experience in just this fund. You can Google their name, you will find their LinkedIn profile and you can check their experience. And you'll see here, right, they have been associated with the fund since 2013. Then again, one more person, Rajiv Mehta here, who has been involved since 2012. So go for fund managers who have at least 7 to 10 years of experience. So opt out from new fund managers if you are a beginner. Next is portfolio diversification. Don't just invest in equity mutual mutual funds, understand your risk appetite, sit with the financial planner, and decide what should be your asset allocation based on your goals. So ensure that you have enough diversification. And when coming to equity also, right, don't invest in just one category. Of course, if your risk appetite is low, you can consider investing only in large cap. But if you are a beginner and young and you have a lot of time to retirement, you can consider mid and small cap as well. And now let's go to the most discussed question: how many funds one should hold? Well, I would say it's subjective. I personally hold about 8 mutual funds and I have SIP in 8 different mutual funds. The most popular recommendation is to have 2 to 4 funds for beginners. So why people suggest 2 to 4 funds, right? Because of two main reasons. One is it becomes really difficult to track these mutual funds when you invest in like say 10-15 mutual funds. And when you invest in a lot of funds, right, there is a lot of diversification or over diversification. You end up investing in just the index and you'll not be able to outperform the index. So these are the two reasons why people suggest not to invest in a lot of funds. So coming to the point why I invest in 8 different mutual funds, right? This includes international funds, gold funds, and equity funds. And also I do a lot of research. I sit on weekends and try to find different types of mutual fund and I invest in them. So if you are ready to do the research and do the rebalance, then you can consider having more funds in your portfolio. There is no harm. And I personally like diversification, even if it means, compromising on the returns, because it somewhat gives me downward protection. Let us say you are concentrated on few sectors or few market caps. And when that sector, or let us say you invested in small cap and the small cap is not doing well, right? Your portfolio is likely to bleed more than a well diversified portfolio. Then coming to the common investor mistake. First is chasing highest past returns. So what we'll do, right? I'll show what people usually do. Once they decide the category, right? I want to invest in equity fund, they will click on returns. It can be any tool, not just value research, right? You can go to Money Control or Grow, or even my website. You can go to Finance Deft. There also we have the funds. So this Finance Deft is my website. You can go to mutual funds. You can sort by highest, by 3-year return or 7-year returns or 6 months returns or whatever you want. And when you're sorting by the fund performance, please choose growth here. If you choose dividend, it will give some random results. So I'll just click on filters and I'll sort by highest 3-year returns. You'll see silver has performed really well in the past 3 years. So don't go and invest all your money in silver. You probably will lose your money. So this is what people will do, right? They'll go to returns. Maybe they will see which fund has given the highest returns in 3 years. And as you can see, right, gold mining fund of fund has given the highest returns because gold has been rallying like anything in the past 2 years, and whoever was mining gold of course got benefited. That's why gold mining company stocks are gone up and the funds investing in them has also gone up. And if I choose a fund category from here, let us say I select small cap, right, and I'll click on returns and I'll see, oh, Bandhan small cap has given 29% CAGR in the last 3 years, and I'll just blindly go and invest that. It is likely that it may not give good returns in the future, and again you'll be blaming the market or whoever told you to invest in the market. Now you'll be asking, how can I select a mutual fund then? So I'll do a separate video on that. There are different parameters to consider while selecting a mutual fund. If I do that in this video will become very long. So I'll do a separate video on that. And the next thing to avoid is panic selling when the market correction happens. As I've told earlier, right? Let's say you invested 1 lakh and the market fell by 30% and you are in a loss of 30,000. Your portfolio is at 70,000. Then you panic and sell. And you go ahead and tell all your friends that the stock market is a scam. This is a place to lose money. Here you didn't lose because of the stock market. You lost because of your stupidity or lack of awareness. And one more rookie mistake is to stop SIP when the market is going down. That is the worst mistake you can make. I have explained in my previous video why market crashes are the best time to start investing or start SIP or stay invested. Then one more thing people do is they check their portfolio very frequently. I used to do that when I started in 2017. Every single minute or every half an hour, 1 hour, I used to go to the Money Control app and refresh and check whether the money has increased or whether it has fallen. So this is one of the problem with beginners. They keep checking their portfolio every now and then they think why the money is not growing or why it is crashing, and again they panic sell. And one more important point is never invest borrowed money. It doesn't matter whether you're borrowing borrow from your parents, banks, or anyone. Just don't invest borrowed money because returns in stock market are not guaranteed. So you'll not just lose money, you will lose your peace of mind, you'll lose your relatives, or you will lose your friends also. So never invest in stock market or anywhere with borrowed money. And this is the one more mistake I have already covered in my rant. Never invest in lump sum if you are a beginner. Always start with SIP, see the market cycle, and invest in lump sum only if you're seeing correction. And while investing in lump sum also, don't invest in one go. Split it into 2-3 tranches and then invest. It's okay if you have missed the bottom. You can invest when the market has recovered a bit also. So as a beginner, always avoid lump sum. Next is how to start investing in mutual fund. I already have a detailed video on that. I'll give you a link in the description below or in the I button, or you can go to the channel and find it out. And the final part is which funds to consider. I'll be talking about few index funds and few categories of funds. Again, these are not recommended. These are just blanket advice, so you should always consider consulting a financial planner before making any investment. So with that warning and disclaimer, let us go ahead. First is choosing between index fund and actively managed fund. So index funds track the index. There is no research or active management done by the AMC or the fund managers. So whatever is the index composition, right? In that ratio, the fund house will invest in the stock. And active mutual funds are actively managed by fund houses or the AMCs or the fund managers who will do the research, and based on the research and conviction, they will invest in the stocks on the ratios they have decided. And if you want to see the portfolio, right, which fund has invested in which stock at what ratio, right? You can come to value research. You can get the portfolio in the AMC's website and you can download that and see. This is an example of Nippon India Small Cap Fund. As you can see, they have invested in 95% in equity and the remaining is in debt and cash equivalents. You can see the sectorial split here, as this is a small cap fund, right? Majority is invested in small cap stock. Then you can see the sector wise holdings here, and below here you can see the top holdings. As you can see, they have highest holding in MCX, that is 2.89%, and you can see other stocks here. And this also gives how many stocks they have invested in and all the details of the fund. You'll see a lot of reports saying that majority of actively managed mutual funds do not outperform the index. While those reports may be true, I personally believe that active mutual funds have an edge over index funds because I personally have invested most of my money in actively mutual funds, and I have seen the funds I have invested in outperform the index. So I could be just lucky here. And for, let us say, 80% of the investors, right, who do not know how to research a fund and study the fund, they can go for index fund. For the remaining 20% who are keen to do the research and invest in actively managed funds, right, they can invest in these funds. So if you're a beginner and you want to invest in an index fund, you can consider either Nifty 50 index fund or Nifty 100 low volatility 30 index fund. As the name suggests, right, Nifty 50 index fund invests in Nifty, and most majority of AMCs or asset management companies will have a Nifty 50 index fund. You can go to whichever AMC is your favorite. There are about around 40 AMCs out there. You can go ahead and invest in that. Next is Nifty 100 low volatility 30 index fund. This is one of the strategy index funds which I found recently. This is very interesting fund because it chooses from the top 100 companies. So it is not just the top 50 companies. Top 100 companies, it selects 30 companies which have low volatility. So volatility is a measure of how fast or how extremes an instrument moves. So more it goes up and down, higher the volatility. So you don't want your instrument or mutual fund or a stock to go up and down a lot, right? So you have to choose a low volatility index fund. And benefit of this compared to Nifty 50, right, it has less drawdown, or whenever the market crashes, right, it crashes slightly less compared to Nifty 50 index fund. So let us quickly check that, and I'll search for, let us say, Bandhan Nifty 50 index fund, and I'll see Bandhan Nifty 100 low volatility. If you see the last 3 year returns, right, Nifty 50 has given 11.83 and low volatility 30 has given 14.56. And of course the market has been crashing from the last 2 to 3 months. Let me select 3 months here. Nifty has given negative 10.9%, and in the last 3 months low volatility 30 index has given negative 9.88. You can see similar result in 1 month also, minus 9.17, 1 month minus 10.7. So it will give you slightly lesser drawdown drawdowns and with a slightly higher return expectation. Next is Nifty Mid Cap 150 Momentum 50 Index Fund. I know it's a mouthful. So what this does, right? In Nifty 150, it chooses 50 companies with the highest momentum. Of course, this fund is for the bull market. In bear market, it's going to underperform the index and you will see pain. So only if you are a high risk, high return category, go ahead for that. Otherwise, you can avoid that. Then coming to active funds, let us say you have an appetite for one mutual fund, then you can go for multi-asset. If you don't have your debt and gold side of things sorted, then you can choose a multi-asset because it will invest in all the assets. If you already have your gold and debt allocation, then you can go for a large and mid cap fund or a flexi cap fund or multi-cap fund based on your risk appetite. Let us say if you have very low risk appetite, then you can go for Nifty 50 index fund. If you have slightly higher risk appetite, right, you can go for a large and mid cap fund. If you want to get exposure to the small cap as well, you can choose a flexi cap or a multi-cap fund. Again, multi-cap fund has minimum cap of investing 25% in each small, mid, and large cap. Flex cap doesn't have that limitation. It is up to the fund manager to decide. Next, if you have to choose two funds in addition to multi and flexi cap, you can choose gold ETF. And if you have appetite for one more fund, that is three funds along with this multi and flexi cap and gold ETF, you can go for international fund. So why I'm suggesting international fund, right? This is mainly for diversification. Yes, you might be living in India and you might be believing in India story, but it's always good to have international allocation and that diversification. If you see the modern history, right, if there is one market that has outperformed India is US market. So it's always good to have exposure to US market. And the last is balanced advantage fund. This usually you invest when you are not sure about the market. Let us say you are not very confident about whether the market will do well in the short term or not, but you don't want to miss on any up move as well. So I'll show what is the beauty of balanced advantage fund if managed correctly. I'll search for Edelweiss balanced advantage fund. Again, this is not a recommendation or I don't get any kickbacks from the mutual fund house. So do your own research. So this is one of the balanced advantage fund. They follow quantitative approach, that is technical analysis. Again, I'll do video on what is technical analysis and fundamental analysis. For the sake of this video, you can understand this is some mathematical calculations based on price they do and decide whether to invest in equity or whether to invest in debt. So if you see their portfolio, right, of course this will vary from day to day and they will publish at the end of the month what is their portfolio allocation. So as you can see, right, they have 83% of equity and nearly 17% in debt. So this equity is not fully in cash segment. That means if the market falls by 10%, the fund will not fall by 8.3% because this is gross equity. This gross equity contains two parts. One is net equity and one more is arbitrage. I have already explained what is arbitrage. They invest in combination of equity and futures and thereby negating that position. So even though market goes up or down, that portion, right, that arbitrage portion won't be affected. You will get that fixed returns, whatever is the arbitrage, right, you'll get that return. So if you go to the portfolio, right, so I'll download the fact sheet here. I'll just maximize this. So if you see here, right, net equity is 55%. That is as on February end. That is the net equity exposure. That is if the stocks that this fund is tracking falls by 10% each, then the fund will fall by only 5.5%, not the 8.2% as the equity allocation indicates, because the remaining is in arbitrage. And if you are more interested in understanding this fund, you can search for this Edelweiss equity health indicator and check how they manage the fund. And now coming back to the beauty of this fund, right, I'll click on return and I'll scroll down here and I'll show you the worst period of this fund. Of course, in the recent history, the worst period has come during the COVID crash. So let's see how the fund has performed. In the worst month, right, it has given negative 16%, and in the worst year, it has just given minus 7%. If you compare this with the Nifty 50 index fund, right, I'll duplicate this and I'll search for, let us say, HDFC Nifty 50 index fund and I'll click on return. And if you see the worst period, right, same COVID crash, you can see the Nifty has fallen nearly 37%, whereas the fund has fallen only 16%. This is the advantage part of balanced advantage fund. And worst year, it has fallen 32%, where the worst year returns is just 7%. During the same in COVID crash. So this is the advantage of balanced advantage fund if managed correctly. Why I keep repeating managed correctly? Because there are only two funds in balanced advantage fund which have this low drawdown or around 16 to 17 percentage fall during the COVID crash. Every other balanced advantage fund in other fund house has given similar returns, that is negative 30, around negative 35% returns during the COVID crash. I'll just show it to you. And one more fund which has given around negative 17% returns is I think Axis Fund, Axis Balanced Advantage Fund. As you can see, right, the worst is around 17% and worst is a year is around 9.5% in negative. You can go to any other balanced advantage fund. Let me quickly open all this in different tabs. So I have opened 4 different balanced advantage fund. If you see worst return for HDFC one is minus 31, for SBI it is minus 27, for ICICI it is minus 26, and for Kotak it is minus 26. So you wouldn't have gotten much advantage from investing in these funds. So when investing in balanced advantage fund, right, you should be very careful in choosing the AMC. Of course, that doesn't mean that in the future when a market crash happens, these funds won't do good and the funds I have shown earlier will do good. There is no guarantee on that. So invest wisely. So thank you very much for staying till here. I'll do another video on how to select a mutual fund. So do subscribe to the channel and hit that bell icon so you will be notified whenever I upload that video, and I will see you in the next one.